Hey, Brittany, when are you going to start this thing? When's Gassman going to get here? Uh, oh, look, there's people watching. Hello, everybody. My name is Ricker and I'm here to warn you about today's program. Today's program will have a lot of math and a little bit of humor if you're lucky, not much wisdom, and a complete lack of humility. Today's program will be exactly like last week's program, so maybe find something better to do. We recommend a Bloody Mary, or if you're in California, 2 Bloody Marys. Like I was saying, the presenter is not very good. Oh, there he is. Okay. Hey, how are you doing? Were you introducing me? Kind of. I'll go draft some documents. You go ahead and do the program now, okay, Alan? Okay. Well, thank you for joining us. And I can only say that this program is not going to get much better. I'm Alan Gassman. I am a lawyer in Clearwater, Florida. And behind me is not a trash can. Now, the reason I have that sign up is because every once in a while, the staff accidentally leaves a trash can behind me while I'm giving a webinar. So I thought it best to just point out that it is not a trash can. And this is not a trashy program. In fact, it's the best program that I'm able to provide with my limited abilities. This is a 1-hour program, although it will seem much longer. And if you came in through CPA Academy's website, you're going to get 1 hour of continuing education as long as you answer the polling questions. There will be 4 polling questions, and we'll let you know when they are, so you don't have to actually watch. You can just have your cat watch. When I go, meow, and your dog barks, you'll know that it is a polling question. If you came in through our website, you get no credit, and I'm not even sure why you are here. Anyway, if you have a question, you can either email me at agassman@gassmanpa.com, and I'll answer you later. Or if you click on the inverted pyramid and stand upside down and type your question upside down, then I will answer your question upside down, which I've never done before, but I'm willing to try. We have a YouTube channel where all of our webinars from Saturdays at 11 are posted, whether you want them there or not. Also, you should be able to take our Thursday report off of the platform here. Is that correct, Brittany? Okay. And if you want to know how to take the Thursday report off of the platform, you should ask someone smarter than me. But there is a way to take it off the platform. You could click on handouts, and then we'll give you $5 and a Thursday report. The Thursday report used to come out every Thursday. Now it comes out sporadically on Thursdays and sometimes on every other day. But this week, we called it the Patty Boyd Report because Patty Boyd will be a guest March 4th at 11 a.m. along with Jim Hartley to talk about nurturing success and achievement. And what successes and achievements did she help nurture? Well, something that you may have heard about, or maybe you like Bell Bottom Blues, to give you a couple of hints of who Patty Boyd is. So she will be here, and then if you will purchase 200,000 records between now and next week, then her songs written about her will have sold 100 million records by our calculations, which don't mean much. Okay, then we have other programs coming. Marty Shinkman is going to join me February 25th to talk about his Practical Planning Quarterly. So enough shameless self-promotion, on to our program. Today's program is about the federal estate tax. And the first thing that Professor Douglas Miller said when I sat down in his estate planning course in 1983 at the University of Florida LLM and Tax program was that the estate tax is a voluntary tax because most of the people who pay estate tax did not have to pay estate tax. They just didn't think about it. And even those who didn't want to pay estate tax but paid some really should not have paid some tax, because there were so many techniques in 1983 to avoid the federal estate tax. And at that time, the estate tax exemption had just increased dramatically from $325,000 a person to $600,000 a person. And I didn't even know anyone in 1983 who was worth $600,000. So now we're at $12,920,000 a person, increasing annually by what they call chained inflation. And in 2026, it is scheduled to go to 1/2 of that. So let's repeat those numbers for those of you who were still thinking about the puppet or Patty Boyd and the song Layla. The 2023 estate tax exemption, $12,920,000 per person, $25,840,000 per married couple, and you can annually give up to $17,000 per person per year to anyone you like and anyone you dislike. And that comes out of your estate and is not included in your gift tax return. So we have clients who have over 100 children and grandchildren. What a blessing that must be, except when it's time to change diapers or buy diapers. But anyway, if the diaper cost doesn't wipe the family out, the fact that mom and dad can multiply $34,000 times 100 people means that they can give quite a bit. On the other hand, mom and dad are not that happy to give that much money to children and grandchildren who might actually spend and enjoy the money. The last thing you want to do is give money or assets to somebody who is going to spend or enjoy it, or if it will cause the person to, quote unquote, be born on third base and think they hit a triple, right? You don't want to spoil your children or your grandchildren or your great-grandchildren. That way you can spoil the children and great-grandchildren of your next spouse. So the $17,000 per year exclusion can be applied to irrevocable trusts. So I can set up an irrevocable trust for my wife and my children and my grandchildren, and I can put in $17,000 per child and grandchild, and then I send them a letter. It's a crummy thing to do, so they call it a crummy letter, because it comes from the case of the IRS v. Crummy. And what Mr. Crummy did in the 1940s is he set up an irrevocable trust. Back then, I think the exemption amount was $3,000 or less. He put the $3,000 in, and the trust said, when I put money in, my children can take out the exclusion amount if they take it within 60 days. So he put the money in. He probably called them, if he had a phone in 1940s, and said, hey, you're going to get a letter from my lawyer. You can open it, unlike the other letters you get from lawyers, but it's going to say that you have 60 days to withdraw money from this trust. Don't do it, or I will break your arm. So what happened? He put the money in the trust. The children did not withdraw it. It was held for their long-term benefit. And the IRS audited it, and they took him to court. And the tax court said he wins. It was a crummy thing to do, but it works. So that is the crummy power, the ability to use your $17,000 exclusion by transferring to an irrevocable trust. And as long as you're transferring to an irrevocable trust for your spouse can have a withdrawal power. It normally, or you should not exceed the greater of $5,000 or 5% of the value of the trust assets, for reasons that I can only explain if you want to fall asleep. So that is the exemption amount and the annual gift exclusion amount. Quite exciting, isn't it? Oh, by the way, what happens if I give that withdrawal right to my children and I put the assets in the trust and I don't tell the children about it? I forgot. What happens? Well, I still get the exclusion if the actual withdrawal power existed, even if my child didn't know about it, according to the case law. But it is safest to let the child know about it. I personally think that it's safe enough for the child to sign something that says, I'm an adult, and I recognize that every year my parents are going to put something in this trust and that I'm always going to have the right to withdraw it within 60 days. I don't intend to. So these annual crummy letters that people are sending may not be as important as they once were thought to be. Okay, now today's program is going to include a lot of excerpts from a program I did in December for the Florida Institute of Certified Public Accountants. A lot of people fell asleep during that program, so if you were at that program, maybe you'll see something you didn't see before. I'm going to now show you some spreadsheets. I'm a spreadsheet affogato, or whatever that is when you like spreadsheets. I like them better than cigars. And we can send you this spreadsheet. If you just send me an email that says the word spreadsheet, then I'll send you this spreadsheet. And what this does is it enables you to show your clients whether they may have an estate tax issue. So here in the middle, I have a married couple with only 10 million in assets, increasing by 7% a year. So you see that after 10 years, they have 18 million. After 15 years, they have 26 million. It's a good day. So when are they subject to estate tax? Well, here in the green, if the exemption stays where it is, they will not be subject to estate tax until 2043. But if the exemption goes to half in 2026, they will be subject to estate tax on the second death in year 10. And what you can do with this spreadsheet is I have this, it's not only 10 million growing at 7%, but they're saving 50,000 a year for the next 20 years. But if I wanted to change the number, I can just click here. I don't have to know how these things work. So I could start them at 20,500. I could bring the growth rate down to 6.75%. I could have them save $100,000 a year. So you see where the danger lurks. So this spreadsheet you might enjoy, or you might not enjoy it, depending upon your threshold of enjoyment. I have a second spreadsheet that we'll send you. You just need to send me the box top from Kellogg's Fruit Loops, and I'll send you this spreadsheet at no extra charge. This is for a single person. So, you know, if you're thinking about getting divorced, then you would use this spreadsheet, not the other spreadsheet, or maybe use them both and decide whether it's worthwhile to get divorced based upon how the numbers come out. The next thing I want to show you, and thank you very much for being mathematically inclined, is a polling question. And I'm going to go to page 26 to go to our first exciting polling question. And I'm going to launch this myself as I learn how to do this. And it is what I call Bob Burke's rule. And other than missing an apostrophe, it is an amazing rule taught to me by the amazing Bob Burke. For every complicated situation, there is a simple solution, and it is A, the right solution, B, the wrong solution, because complicated situations call for complicated solutions. So the answer here is B or C, and then the other alternative is D, the party you have dialed is not a working number. So, by the way, it is a working number, it's just a recording. All right, everybody needs time to answer this. B and C are the same. So they're BC. Oh, meow. For those of you who are not watching, it's a dog of a question, and we are closing the polling question. You snooze, you lose. The next thing I want to point out about the federal voluntary estate tax is that interest rates are going up, but starting to stabilize. So in April of 2022, back when I was young, the 75/20 rate was 2.2%, and 120% of the midterm rate was 2.24%. So certain mechanisms that we can put together, including grantor retained annuity trusts, qualified personal residence trusts, charitable lead annuity trusts, work based upon what the differential is between these rates and how an asset grows. So any growth over 2.24% would be out of your estate using a GRAT. Any growth above 2.2% generally would be out of your estate using a qualified personal residence trust. Well, that's changed now. Those rates are up to 4.45% and 4.4%. And the rate that we can use for a promissory note. I just had a family loan their son $1 million so he could buy a home. Obviously, it was a very small home. So what interest rate will they use for this loan? They can use the applicable federal rate. So the applicable federal rate right now for March 2023 is 3.74% if we go over 9 years, 3.7% if we go over 3 years and up to 9 years, 4.5% if it's a demand loan or up to 3 years. So we used to always do demand loans because they had lower interest if it was short term, but now you would go with a 3-year or longer note. Still on the $1 million, he has to pay the family trust $37,400 a year. The family trust takes that as interest income. He gets no deduction. So we're probably going to do a co-ownership. It would have been different a year ago when the rate would have been 2.14%. So these rates are going up in general. And if you're going to do what we call an installment sale, you want to do it pretty quickly. Okay, so now you're saying, show me more, show me more, show me more. I heard you say that. Thank you. I'll show you more now. Here is a very, very effective estate tax planning technique for families in the 15 to 100 million or even more fair market value arena. You have a spouse 1, spouse 2, they have revocable trusts. Revocable trusts do nothing while you're alive to avoid estate tax. We'll talk about what they do when you're dead. I mean, we'll talk about what they do today if you are dead. I'm not saying that we'll talk about this after you're dead, although if you die during the presentation, we will continue talking. So this family puts $19,500,000 worth of investments under an LLC, and then they keep 1% voting, 0.9% voting jointly, 0.1% voting under a trust for their children, and they own 49.5% non-voting in each of their revocable trusts. So they basically own the LLC. Now, some of you are from Virginia, and you think I'm talking about North Virginia, but North Virginia and South Virginia are not states. As you probably know, it's East Virginia and West Virginia that are the 2 states. In any event, the husband sets up a spousal limited access trust for the health, education, maintenance, and support of his wife. He gives it an $800,000 gift, which we call a seed capital gift because he's a farmer. And then the wife sets up No, she doesn't. The wife keeps 49.5%, but she sets up a trust for descendants because she doesn't like the husband and gives it an $800,000 seed capital gift because she's also a farmer. Okay, now what do? The husband sells his 49.5% non-voting member interest to the spousal trust for an $8 million note. Now you're probably saying, why isn't that a $9 or $10 million note? Because it's almost half of $19,500,000. And the answer is valuation discounts. When I sell a non-voting member interest, I can take a discount. So I have the assets in this LLC quite a few days before I make the sale. If you make the sale immediately after you put the assets in the LLC, you don't get the discount. So what have I done? I've taken a $19,500,000 asset and I have converted it into 16 million of installment notes. And they're bearing interest in my example of 3.88%. So about 4% of about 8 million, about $320,000 a year comes back to each of them. That gives them $640,000 a year to live on. And in the meantime, these assets are going to grow, grow, and grow. So how does the growth work? I will oversimplify the growth. 19.5 million in the LLC, growing at 5% per year, gives you 975,000 of growth. The combined promissory note payment, 617,000. At the end of 20 years, the LLC has $24 million in it that will never be subject to estate tax. And the note payments have been 12 million. So you can see how incredibly effective this would be. After 10 years, there's 24 million outside of the estate for estate tax purposes. What this is it's the 19.5 million growing by 5% minus the promissory notes. And after 20 years, you have 31 million outside of the estate for estate tax purposes. All right, so now I'm going to use our Estate View software. This is a proprietary software developed by my son-in-law, David Archer, who is a computer wizard and MBA, Professor Jerry Hesch, and I helped a little. And what we wanted to do was we wanted to develop a program that could show practitioners and non-practitioners how the federal estate tax and estate tax planning works. So it's an easy to use software program. If you're a client of our firm, you can use it for free. And if you're not a client of our firm, it's very, very, very expensive. It's almost $100, which just about pays for the maintenance costs. So anyway, you can put your law firm's name and your planner's name, and then your spouse's name, the first spouse's name, their age, and then it will tell you their actuarially expected date of death. And then if they're a tobacco user, you can click there and that'll tell you that they'll die sooner. And then you can give an expected date of death. I went with 10 years. And then a surviving spouse, I went with 20 years to 2053. And then just some general asset information. They have a $2 million home and everything is scroll up and scroll down. Let's say the home went down to $1.5 million. It's growing at 3% a year. Then they have business and investments of $20,500,000, growing at 7.23%, with annual costs of 0.4% and taxes averaging 1%, including capital gains. Now, if they own a business, that might be much higher. Maybe it's 2%. You can just click up. Then they're saving $600,000 a year, much of that from an S corporation that shoots off a couple $100,000 a year of income. And after the first dying spouse, their savings are expected to go down to $300,000 a year. The client does not believe that the estate tax exemption is coming down to half in 2026. And they also expect that there will be a portability allowance. So what is a portability allowance? Well, this has nothing to do with mushrooms, although if you like mushrooms, that's fine. The portability allowance says that if I pass away and I leave $920,000 to my children and everything else to my spouse outright, not in a trust, then my unused estate tax exemption of $12 million goes to Marcia, and it's called the portability allowance. And then her exemption then is going to be $24,920,000. So this software keeps track of the portability allowance. And let me make mention that the portability allowance is not as good as mushrooms, because if she remarries and her next spouse dies before her, then she'll be stuck with his portability allowance, not mine, which may be much, much lower. And the portability allowance does not grow with inflation, and it does not give you the ability to generation skip, which is maybe something we can cover next week or the week after. So let's go back here. Now, on my death or on Bob Sample's death, how much can go into a trust that can benefit Mary Sample without being subject to federal estate tax at her level? And the answer is up to $16 million. That's based on $12,920,000, adjusting for inflation for 10 years. Then they have 6 children and grandchildren, and they will be able to gift LLC interests, assuming a, let's say, 25% discount. And I'll explain that in a little while. They have no life insurance, and then I'll explain the installment sale in a little while. So let's see where they are. Well, like most clients, they say, hey, we need this estate tax plan. We want it to cover all the bases. We want you to make sure that you thoroughly handle it, put all the stuff together, because we're going on vacation in 4 days. And by the way, if we die on the plane, will we pay an estate tax? So the first module here, you see on the top right-hand side, is both die this year without any planning. And what happens? They've got $1,500,000 residents, $20,500,000. Time for polling question? Okay. I'll do a polling question in a second. $20,500,000 of investments. In 1 year, it's grown a little bit, but they're well under the exemption amount. Their exemption amount is $24,820,000, so they pay no estate tax. And we go to the second polling question, which is at page 45. One of my favorite pages is 45. And the polling question, which I will launch because I want to, launch. Are you interested in more information on the National Institute for Charitable Education, which is a 501c charitable organization which publishes books and articles on charitable giving to enable law students who get credit or are required to do charitable things, something to keep them off the streets? If you know any law students who would like to do writing for the National Institute for Charitable Education, or you would like access to their materials for free for a charity, then your choice is A, yes. If you are not interested, the choice is B. And if you have ADD or forgot to hear the meow, then the answer is C. What is that? And yes, most people answered no. And the second most important was, what is that? All right, so we'll explain it to the cats later. Back to our exciting story. Now, what happens if Bob and Mary don't die on the plane? Instead, they also don't do any planning, and their assets grow at the growth intended. I go to no planning, I click on no planning there, and what happens is by the second death, look at the time value of money here. 7.23% plus 600,000 a year brings them to a $200 million estate. Most people don't believe that, but that is more likely than anything. And a $64 million estate tax. Thus, the $64 million question: is estate tax planning worth doing? And the answer, I hope you will agree, is yes. Now, I want to mention that if you want to make changes to the assumptions midstream, you can. For example, they go, oh, we forgot about the vacation home is worth $1 million. Okay, well, we'll just go ahead and scroll up here and add another $1 million. And all the numbers change simultaneously. And they may say, we don't really save 600,000 a year, we save 500,000 a year because of all these legal fees. Okay, we'll turn that down, all the numbers will change. Now, what about if they fund a credit shelter trust on the first death? And you may say, who cares? There's the portability allowance. But I say no, because if you fund the credit shelter trust on the first death, then the growth in value of the credit shelter trust is out of their estate. And let's see if that saves anything. I click credit shelter trust, and look at that estate tax. It went down from 65 million to 47 million because the credit shelter trust has $60 million in it by year 30. Please remember that the rule of thumb for a properly allocated conservative investment portfolio is it will double every 10 years. So when you talk to your clients and say, hey, today you have 20 million, in 10 years, 40, and in 20 years, 80. More likely than not. It may be more, it may be less. And maybe they have you change the assumptions and say, well, you know, maybe the business isn't worth what we thought it was worth. Let's move that down to 18 million. And, you know, we don't think it's going to grow by 7%. It'll grow by 6%. All right. Well, you still have a $22 million estate tax issue. Do you want to just go ahead and leave a bunch to charity? How about to a charitable foundation that your children can run? And then there will be no estate tax. Or how about a charitable lead annuity trust, which pays to charity for 20 years, and then about half of the rest is left and will go to your children, but they'll have to wait 20 years. And then there's no estate tax. And most clients say, no, I think I just want it to go to my children. I don't want to be complicated by charity and charitable lead annuity trusts. Okay, I'll try to discuss that with you next year. Maybe you'll be more worldly next year. But in any event, the client says, well, what about that annual gifting? Remember, I can give $17,000 a year to all those lovely children and grandchildren. Okay, I click on annual gifting. Not a bad gig. The gifting trust by the 30th year has $15 million in it. That's pretty good. That reduces the estate tax by 40% of 15 million to a scant 16,590,000. The family's getting 117 million. Why are they complaining? Well, no one likes to pay taxes. How about if we do this? We'll put $1 million in an LLC, and then instead of giving gifts of 192,000 of cash a year, we'll give gifts of limited partnership or limited liability company ownership interests that are really worth about 230,000 a year. So I click on discounted gifting, and we'll see what that does. You see the 15 million there? Okay, tell your cat to watch. I click on discounted gifting. Now it's 20 million. Now the estate tax is down to 14 million. And we have an LLC in this family, an LLC that they've always wanted, an LLC that they can name cleverly, an LLC in Nevada that they can visit when they go to the Strip. Okay, now life insurance planning we will cover later, not right now. So what is this family going to do? this family has a $15 million estate tax issue. Well, what I propose for this family is that they place $1 million as a seed capital gift into what some people call a SLAT, or some people call it an intentionally defective grant or trust. It's an irrevocable trust. It is out of their estate for federal estate tax purposes, not having anything to do with dolphins, and all growth of it is out of their estate. And another nice thing about this trust, besides the fact that I get to draft it and charge for it, is that the income tax on the income of this trust is taxed to the client, because the trust is disregarded for income tax purposes. So that enables their estate to get smaller and the trust to get bigger. And then, so if I only do that, then I'll have more savings, but not a significant amount of additional savings. So here's the next thing I do, and I'll even out the math here. I put $14,214,000 worth of conservative investments and S corporation stock into an LLC, or I put a couple $1 million of S corp stock and 12 million of investments aside. The 12 million of investments goes in the LLC, and then separately I have the S corp stock. The S corp is yielding 300,000 a year. It's worth a couple of million. I assume a discount rate of 30% because I keep the 1% voting rights and I sell the 99% non-voting rights. So the value of what I sell, even though the LLC and the S corp are worth 14 million, we value them at 9,950,000. And we sell them for a 4% interest rate note, bearing interest only for 20 years. So what's going to happen is for 20 years, the growth is going to stay 99% in the trust. The trust is going to pay about $400,000 a year to the family. The trust is going to grow. The LLC is going to grow at about 7% a year. And the S corporation is going to throw about $300,000 worth of income into this trust, which is not going to be in them anymore. So it reduces the 600,000 that I showed you up here, or the 500,000 that I showed you up here. So I click on installment sale, and now the estate tax is down to $1,164,000. I have sawed her in half and can restore her now. That is quite a trick, isn't it? Now, if I wanted to make sure that this will work based upon each year to see what goes on with this installment sale and this installment note each year, I can go to what's called a timeline, the timeline here, click in there, and this shows me that I've eliminated estate tax for each year that they're living with this installment sale until the very end there. And if I want to say, well, what if the first death happens sooner or later? I can move it left or move it right, and it shows me what is in the installment sale trust, which is a lot, what's in the gift trust, what's in the bypass trust, what is in the taxable assets, and what the estate tax is. And if I hadn't done the installment sale, if I back down the installment sale to a smaller installment sale, you see that the estate tax would go up. So by the same token, if I only use the credit shelter trust, you see a larger estate tax depending upon when the first spouse dies. Now go back to trust logistics, and now I can play with this and decide what I want to show the client. And what I'm going to show is a larger installment sale so that I can get this estate tax down to 0. and then they'll think I'm really smart. I will have them fooled. Okay, but the trick here is I've put them into a negative situation, so I can only go so much here. In any event, the next thing I'll do, for those of you who are saying, wow, he went way too fast, I have no idea what he said. Well, for you, I'm going to generate a client letter. I click right there on generate client letter, and now a letter has been drafted. It took 6 hours to draft this letter in the old days. And what this letter tells you is, here's all the assumptions. Here's how the tax works. Here's all the assumptions that we put into your situation. Here's without planning, 35 million of taxes. Here's with the bypass trust, 32 million of taxes. Here's with annual gifting, non-discounted, 24 million. The whole thing is in a Word document. If you want a copy of the Word document, just let us know. We'll be glad to send it to you. It's all part of that program. Now, the next thing I want to cover before I get to the next polling question is the self-canceling installment note. So right here, I have a $17 million note. And when the client dies, the $17 million note, oh, I'm sorry, the $12,400,000 note. When the client dies, that note is subject to federal estate tax. Now, we could probably discount the value of the note and pay estate tax on maybe 10 million instead of 12 million for, but it's still estate taxable. Well, the client calls me and says, you know, we just set this installment sale up, but I just got some bad news. My life expectancy is probably only 4 years now. So what are we going to do? I really don't want to pay this estate tax. All right, what we can do is we can change the promissory note to what's called a self-canceling installment note, also known creatively as a SKIN, S-C-I-N. And if you Google Gassman SKIN, HESH, H-E-S-C-H, articles will come up that describe planning with a SKIN. But under the regulations, as many of us read them, you can add to the interest rate based upon some standard interest rates. And in this situation, the interest rate on the note would probably have to go to about 7.5%, maybe 8.5. So the note is self-canceling. And if the client dies within their life expectancy, which is a 20-year note, then the note cancels and there's no federal estate tax. It goes to zero. So that would be the self-canceling installment note. And for those of you who are practitioners, after this second to last polling question, I can't believe how fast this hour is going. Maybe there's a problem with the clock. Okay, we're going to go now to page 73 for the next polling question. And I'm going to reset this to the next polling question as I learn to use computers as if I were an 11-year-old. That's not to criticize 11-year-olds, by the way. All right. There is a fellowship program at the Stetson Law School where students of color are receiving a grant to join local estate planning councils, attend their meetings, and put together programs and lectures to help people of lower socioeconomic backgrounds to know more about estate planning. If you are interested in having your estate planning council or your law firm or CPA firm sponsor such students, or if you want more information on this, the answer is A, if you're interested in sponsoring, B, if you want more information, or C, not today. Meow. By the way, that is not a real cat, but that is a real dog of a voice. Okay, the poll is closed. Now, for those of you who are practitioners and those of you who are not practitioners, let me see if I can latch on to this thing. Latching on, please. Latch on. Oh, have a problem. Computer stalling. Hello, hello. All right, now it's working. Let me see, did I lose? There it is. I think my software program stopped. Okay, we'll go on to something else, and then the next time we'll go on to this. All right. Go to some examples of planning. What I want to cover here on page 33, with just 15 minutes left, are some estate tax planning strategies that are commonly used and commonly forgotten. The first one is stop starting new businesses. You're so smart. You know how to open a store. You know the store can make money. You know how to open manufacturers of widgets. You know how to do real estate deals. Well, do them under trust for your children. Stop doing them under your own name. Okay. Number 2, we talked about annual gifting and crummy trusts. Number 3, the irrevocable life insurance trust. I can have a life insurance policy on my life. I'm paying the premiums. On my death, it goes to the credit shelter trust or to my wife. And on her death, whatever is there is subject to estate tax. Or if it goes to the credit shelter trust, it has reduced my wife's portability allowance, which influences her mushroom intake. Instead, I can form an irrevocable life insurance trust. My wife can be the trustee. She can get what she needs for health, education, maintenance, and support. She can direct how it goes when she dies. If it's an existing policy, it needs to be in there 3 years before I die. Now, when I pay the premiums on that life insurance trust policy, that's going to use part of my $17,000 a year exemption, unless I use something called split dollar, which is like a loan, but it's less than a loan as far as the interest charge if you use equity split dollar. So these should be considered for the estate taxable family. Number 5, we want to use the defective grantor trust. That's what I showed you, an irrevocable trust that is out of your estate for estate tax purposes, but if you like, it is considered as owned by you for income tax purposes. I'm paying the income tax, but that's not considered to be a gift. On the other hand, if you're in a high income tax bracket state, for example, this week I had a consult with a client in Michigan. Well, he put some assets that throw off income into a Nevada irrevocable trust that's not disregarded. It pays its own taxes, so it's not subject to the Michigan income tax. Now, don't tell anyone in Michigan about this. Okay. Then number 6, use those discount vehicles, use non-voting or North Virginia LLC interests. You can gift them, or you can even die with non-voting interests and pay less estate tax. Use installment sales to lock in those discounts and to have a 3.85% rate of return instead of the higher rate of return that you would normally expect from an investment portfolio. Number 8, use self-canceling installment notes when you have a client or individual who is not in good health and has a short life expectancy. Now, you have to do that carefully, and we could spend a couple of hours on self-canceling installment notes and private annuities, but talk to somebody who understands them and see how they fit into your situation. And by all means, if you get a bad diagnosis, call your spouse first and me second, your clergyman third. We want to help your family, and you don't want to waste time when you get that kind of diagnosis. Similar to the installment sale to a trust is the grantor retained annuity trust. It is safer than an installment sale to a trust. If I do an installment sale to the trust of my business and I say my business is worth $5 million, sell it to the trust for $5 million, the IRS comes in and says, no, it was really worth $30 million. You made a $25 million gift. I may be able to use what's called a Wandry clause or a formula clause to try to ameliorate that risk, but I could use a grantor retained annuity trust and almost completely eliminate that risk. So when clients are in the 75 to 375 million or even higher bracket, and they want to do this kind of planning, more often we're doing grantor retained annuity trusts in addition to installment sale arrangements. Okay, 11, we talked about credit shelter trusts. 12, we talked about portability. 13 is the qualified personal residence trust. Let me see if I can find the qualified personal residence trust chart. That's not it. Is that it? That's not it. Oops. Okay, I apologize. I'll show that next time. I'm having my computer glitched, believe it or not, and some things disappeared, including my memory. Okay. Next, the charitable lead trust. And I'll give you a simplified example. I could leave $10 million to my descendants and pay $4 million in estate tax, or I could leave $10 million in a trust that pays my favorite charity 11% of its value, of its initial value per year for 16 years, and then what's left at the end of the 16th year goes to my children, and there can be almost no estate tax or zero estate tax if you go 20 years. And if you fund the charitable lead trust with a discounted asset, there may be 50 to 60% of the initial value going to the children, while also funding a family charity. So that's the charitable lead annuity trust, known also as the Jackie Onassis Trust, because she had charitable lead annuity trusts in her last will and testament. Number 15, if you're charitable, consider an administrative note arrangement. If you don't know what that means, ask about it. Consider private and public foundations, and then there are other techniques as well. So let me now go to the last polling question. Then I'm going to take questions and answers, and then I'm going to finish on time if possible. As you can see, I covered about 10% of my outline, and I look forward to covering more later. All right. Polling question number 4. Patty Boyd, who is going to join me on Saturday, March 3rd to talk about professional success, is A, or was George Harrison's first wife, B, named by the song Layla, and Bell Bottom Blues, and Something in the Way She Moves, and I Need You, sold almost 100 million records, by 200,000 between now and then, and we'll hit the number. D, joining us March 4th, 2023, 11 a.m. Eastern Standard Time. And E, all of the above. And I met Patty when I bought an autographed picture of George and Eric that she took in 1972, I believe, while she was married to Eric and hanging out with George. So very, very small world, a very, very lovely lady. All right, now we're going to answer some of the questions. I can't answer all of them because I don't know the answers. But, okay, am I going to do anything re the Corporate Transparency Act and trusts owning covered entities? Yes, I'm going to offer my clients the opportunity to have our law firm file their corporate transparency form, which will be due at the earliest in 2024, I'm hoping that this will be extended, but it is a federal law that all entities filed with the Secretary of State, other than publicly traded entities generally, will have to file a little form. It should be simple because the government is estimating that it will only cost $84 per taxpayer to file them, but that is coming. Good morning from Hawaii, Sherry. Aloha. Thank you for joining us. Hello from South Carolina, Patricia. Thank you so much from Key West, Christine. Okay, let's go to some other questions. Some of you have asked about the spreadsheets. Okay, here's a question. Is it a real cat? Meow. No, it's not a real cat. You obviously weren't listening. Okay. What is the best planning technique for S corporation stock? And I think the answer for S corporation stock for estate tax planning is almost always going to be an installment sale of S corporation stock to a defective grantor trust, or using a grantor retained annuity trust. And let me say from experience, because a lot of people come to us after a good estate tax plan has been put together, and the planners generally are confident on what to do with stocks and bonds, what to do with the real estate, and then the family business, which is the goose laying the golden eggs, gets forgotten. So we like to go ahead and take that S corporation, make it 1% voting, 99% non-voting. The client and a trust that controls liquidation and distribution rights will own the 1% voting. The 99% non-voting will go to a separate trust, not to children, but to a separate trust in exchange for a note or in exchange for a right to receive a series of payments. And that can work very well. Now, if you're charitable, then some of the S corporation assets, including the goodwill, could be contributed by the S corporation into a charitable remainder trust, which would then pay the S corporation up to 11% of its value every year for 11 years if there's income. And then those assets could be sold by the charitable remainder trust, and you would pay no income tax until the distributions come out. And if you do that, what is the value of the 99% non-voting member interest in the S corporation? Even a bigger discount. Now, you can't put substantially all of the assets of an S corporation into a charitable remainder trust, or you will trigger taxable income as if the assets are sold. Okay, then Lynn asks me, what if a client's company is a C Corp and not an S Corp? Well, then you could put the C Corp stock into a charitable remainder trust if you want to defer tax on the sale of the stock, or sell the C Corp stock for a note that's non-voting C Corp stock, or you may want to make an S election. I think a lot of C Corps out there really should have made an S corporation. Okay, Mong asks, when a grantor puts money into an IDGIT, an intentionally defective grantor trust, is that a gift? And the answer is yes, that is a gift. Now, Abigail points out that when you lose your spouse, you have to file an estate tax return in order to get the portability allowance, and that now you have 5 years from death before you have to file the portability allowance estate tax return. But Abigail also asks, do you think that an estate tax return, Form 706, filed solely for portability is considered in determining when a 645 election terminates? Wow, I have no idea, but I will guess no. Okay, then Karma says, and has good karma, could you please increase the amount of gifts given each year by paying for expenses directly in addition to just gifting? Yeah, I should have mentioned that. You can pay medical expenses, including plastic surgery, so that your in-laws are more attractive. And those are not considered to be gifts. And you can pay tuition directly. And you can also fund a 529 college savings plan based upon 17,000 times 5 this year and use up your future gifting in that manner if you have good manners. So all of those things are there. I'm going to go ahead and conclude the presentation. And wow, that made my head spin. Wow, it made his head spin. See that? All right, we'll see you next week. And we hope that it's less bad next week. All right, thank you very much. And have a wonderful rest of your weekend. Thank you.